building an assumption from A to Z, what we look at, how we kind of approach the markets based on what's happening day to day, based on what's in our portfolio. Do we want to add bullish, bearish, neutral trades? Do we want to remove bullish, bearish, neutral trades? Do we want exposure to certain sectors? It's all laid out right here.
Yes, it comes from many an email we've gotten of, I understand volatility and time and your thoughts on that, but how do you get long, how do you decide to be long or short? And hopefully we'll help add a little bit of context to that. But I think as you'll ultimately understand, it's personal preference. There's lots of variables there. So firstly, I think the first thing you should do is to figure out or to have a general market awareness, right? So keep track of the markets as a whole. When I read through my list every day, it's the same list, same order. I'm always looking at the market as a whole, the major indices. I look at volatility, I look at oil, I look at bonds, gold, silver, Bitcoin. If you want to get into the ags, you can look at the ags as well. But it's important to understand what's happening in the market overall. And, I also get the question of why do you read those off specifically and not not your own positions? And it's because when you look at the E-minis or you look at the Dow or the Russell, it incorporates a very broad, wide range of people's positions, right? So if you mainly trade in NASDAQ stocks, and I say the NASDAQ is up 100 points, and you have 40 positions and they're all in tech NASDAQ-y names, you know that your portfolio is probably doing well as a whole. I'm not looking at specific underlyings or specific trades. I'm looking at it as just kind of a broad-based understanding of what's happening in the market. So looking at those indices, very, very important. As for building a narrative and building a directional assumption, whether it be long or short or neutral, a specific sector or indice or a specific stock, some people use price levels, right? You look at, and this is kind of what I like to use, right? Where's it been trading recently? Where's it been in the recent past, 3, 4, 5 months out or a year out in the past? That can help you at least build the narrative of okay, I'm getting long at a relatively low price, or I'm getting short at a relatively high price, or maybe I'm trading this neutral because it's been sitting in a pretty tight range for X amount of time. So I like to use price levels. You can also look at specific sectors, right? Chips have been hot. We talked about TSM with Thomas on Wednesday, which had earnings and it actually dropped. But we were talking about, hey, NVIDIA and AMD and SMCI and all these chip stocks are going to the moon, and TSM hasn't really moved. Maybe there's an opportunity there. Didn't turn out to be the correct opportunity, but you can kind of build a narrative around that. A lot of people, when they look at stocks or ETFs or anything like that, they, will consider what's happening in the news. Is something, do they have a binary event, or is everybody talking about it, FOMOing, blah, blah, blah. You can build a narrative that way. You can build a narrative based on fundamentals, right? Some people say, oh, well, NVIDIA's at a 250 PE. That's insane. Or Tesla is just a car company, and that's, its price is insane. You can build that fundamentals, to build an assumption, and then you can get into the technicals, right? You have the SMAs and Fibonacci's and MACDs and all that stuff. Those are all things that help build a narrative. I think the question you have to ask yourself and the ultimate decision-making process is, what time frame am I trading, and does whatever I'm looking at matter? Right? So does the news matter for this underlying? Does the fundamentals matter if I'm trading on a 30-day time frame? Does this technical matter from a bullish or bearish narrative? You kind of have to take all of those things and all the things that you like to look at in that list and ask yourself if it matters for the trade that you're making here.
Yeah, I think the biggest thing, and I'm glad you pointed this out, what time frame are you trading, just changes everything, right? Because you can build the assumption on the underlying, and let's say I'm bullish in Microsoft. If my time frame is 2 years, then I'm not going to sell a put. I'm going to buy a leap. I'm probably going to buy an out of the money leap. But if my time frame is 15 days, 20 days, 30 days, I'm not going to buy a call with 30 days to go where I know that I have a ton of liability with that decaying call. I'd probably sell a put in that case or a put spread or something like that, or a call diagonal spread, something like that. So the time frame that you're trading will greatly push you into certain buckets of strategy. So that is a good call out there. And you know, you can build your narrative however you want. Some people like looking at technicals and then they pair it with high probability trading. Some people look at fundamentals and pair it with high probability trading. So just looking at all the things that make you comfortable to pull the, or click the button, I guess you'll say. Mm-hmm. And everyone's different. Everyone's got their subjective view of what makes them comfortable to generate that narrative. But at the end of the day, the time frame that you're trading will have a great impact on your strategy.
For sure. All right, so the question of directional assumption, I get this. This is a direct copy from an email that I got very recently. How do you arrive at the long-short directional bias? It actually started with, you know, the whole idea that they understand volatility and time and all that stuff, but how do you get to the long or short? So the easiest way and the most basic way that I explain it to people is that, you know, there's generally 4 outcomes when it comes to stock price over whatever time frame you're looking at, whether it's 1 day, 10 days, 50 days, 1,000 days, doesn't matter. 4 things can happen, right? So the stock can move outside the expected move, which is how I look at realistic expectations for a stock, right? I look at the expected move and I consider these 4 options. So the stock moves outside the expected move, the stock moves outside and down, the stock moves inside and down, the stock moves inside and up, or the stock move is outside and up, right? So you have, you know, big moves to either direction or in the middle on either side, right? For stock positions, like if you're just buying or selling stock, your outcomes are 50-50, right? You buy stock, you only profit if the stock goes up, whether it's inside or a huge move to the upside, those are your only 2 positives. If it's down a little bit or down big, those are your 2 negative. If 50-50, it's binary. For options, you benefit from the strategies that we trade and we do. You have at least 3 of the 4 situations in your favor. And this doesn't matter about what time frame you're looking at. The example I'll use is I'm selling a put, right? So you sell an out of the money put. Let's say it's 20 delta put or 30 delta put. It benefits from the stock trading in a range, right? So you benefit if the stock goes inside, down a little bit, even though you're bullish, so to speak, you have a bullish position. You definitely benefit if the stock goes up a little bit, and you definitely benefit if the stock goes up a big amount, right? So 3 of the 4 outcomes are net positives for you over the duration of that trade. You know, the trade, and in the example of selling a put, you are going to be long delta, right? So you're long, you have a bullish sort of assumption here, but you don't necessarily need the stock to go up. You're not, the position isn't binary like it is with actual shares of stock. You have multiple outcomes that can help you there. So you have that sort of, you know, variable that plays into your directional play, but you don't have to be right on the direction necessarily. So ultimately, the directional assumption, and I highlight assumption because delta is certainly a very important thing, but the actual directional assumption on the stock is much less important, right? It's going to be very random, especially when you're looking at shorter durations like we trade on, you know, sub 50-day timeframes. You know, that is a tiny, tiny piece of a long-term chart. So the directional assumption is less important than your exposure and the entry points of your exposure to volatility and time. Those are more directly tradable, right? So I don't know what the stock's going to do in a week, where it'll be, if it'll be one of those 4 options, inside up, big down move. I don't know that, but I know that when volatility gets very high, it tends to mean revert. And I know when volatility gets very low, it tends to increase and mean revert. And I know that time is going to pass. And so those are the 2 things that you can control on entry. The directional assumption is variable and isn't as strong as people think. Just because you're selling puts doesn't mean you're like bullish on the stock. It just means that volatility is high, you're trading time and positive decay, and you got a slight directional bias to the position. It's not like a all or nothing type position. And lastly, you have to keep in mind efficient markets, right? If I sell the put at $1, you can buy the put at $1, right? So you can taking a bullish or bearish trade, it's the same value, and there's the same, your risk rewards are different, but taking one side or the other is the same price. And so, your Mike might be bullish and he might want to sell the put, and I might be bearish and I might want to buy the put. Nobody has there is no better choice. Nobody is right in their assumption. That'll be determined in time. Right now, you can make that trade for the exact same price and, take which direction you want.
Yep. And again, going back to the time frame of the trade, and like what Nick said, how you don't know what's going to happen with the stock in a couple of days, but you can have a stronger opinion on the general market rallying X percent over 2 years, 3 years, and maybe a particular stock rallying over a couple of years. Like Target's a good example. Target, we have bullish positions on. It's a well-known retail stock, but it hasn't really participated in the market upside. So maybe as the inflation worries calm down and the jobs reports keep coming out strong, maybe we'll see a rally in Target. So that's our long-term assumption. So we have more of a long-term play in those types of underlying. So it all comes down to what you want to do, having an opinion on something, and then utilizing your time frame to kind of push you into certain buckets of strategies.
Mm-hmm. Cool. All right, so just a quick little list of entry tips. So, of course, with strategy, it's got to fit your directional assumption. However you're looking to trade this, like if you want to be neutral or bullish or bearish or slightly neutral, slightly bullish, slightly bearish, it's got to fit your directional assumption. Don't take my trade. Don't take Mike's trade if it doesn't fit your narrative. Right? So nobody knows anything, and you could take the opposite side for the same exact value, so to speak. So just keep that in mind. You always want to consider like your correlations to the portfolio or the positions as a whole, right? We always talk about having a little bit of diversifying strategies, underlying sectors if possible. You can get into futures and all that stuff. So adding a little bit of diversification there. Sizing's one of the other things that you can control on entry. So 1 to 3% per defined risk position. That's of your net lick. So if you have 100 grand, maybe up to 1,000, 3,000 as your kind of max risk on a spread trade. Up for naked positions, up to 5%. We naturally have and use more buying power on naked positions, because they're going to be higher probability trades. They're further out of the money. They're going to be faster decaying, et cetera. And for account sizes, you're always going to be, in smaller sized accounts, you're always going to be using more capital than you will be in larger sized accounts, just because of capital limitations. Order entry. So we look for 0.1% of the stock's price for the bid-ask spread. Again, going back to the efficient markets, you can take the opposite side of any trade for basically the same value, except for those trades that have wide bid-ask spreads. When you're looking at penny-wide markets and SPY, they're basically the same price. When you're looking at something in CMG, it's going to be a very, very wide spread there. So we always want to have tight spreads to get filled in and out of our trades efficiently. Anytime you have more time on your position, you're going to have slower moving trades, less Greeks. So that's another thing that you have to consider. Goes back to our talk on time frames. And then the portfolios as a whole, we try to keep a little bit of powder dry, especially when volatility gets low. You got to account for buying power expansion, potential new trades that come, hedges if you want to put those on. So we always have some sort of cash on the sidelines. Of course, you can, you always want to have capital available for new positions, but you're still going to have enough leverage, right? When you're 50% of your capital is being used with margin accounts, you're typically going to have 2x or 3x your notional value. So it's not like that cash is doing nothing for you. You're always over leveraged to the actual capital that you have there. And again, smaller accounts, it's much harder to get, to keep money on the sidelines because, you got to put positions on.
Mm-hmm. Mm-hmm.
All right, things to avoid. So our daily considerations, so to speak. Thinking there is a best trade or strike or underlying to trade, of course, just goes back to everything that we've talked about. It's efficient markets. You can take the opposite side, all that stuff. The day-to-day movements are largely random. So if you're trading something on a 1-day or a 30-day, there's a big difference in those trades. 1 day is basically binary. You can trade on with different size or exposure. You can do naked puts versus put spreads. That's all kind of your own risk tolerance, your own directional assumption, size requirements, etc. Always want to look at, your exit plans and entry plans, just like, picking your assumption and building your assumption. You want to have an assumption about how you're going to exit the trade if something goes wrong or if it goes right. You don't have to be super strict on it. It could be kind of like a trader's instinct thing. I think that's kind of how we trade more often. If you want to be more rigid and exit at X amount at X time in the day, that's totally fine, but it's something that you should definitely be thinking about. Of course, with number of occurrences, we want to have as many as possible, but you don't have to get them on all right now. When we talk about number of occurrences, we study over years and years and years. You don't need to get 1,000 occurrences today, especially when volatility is low, because the assumption is that we're going to keep doing this for a very long period of time. So your occurrences will come with time, rather than just getting them all on right now. And of course, with small accounts, you want to focus more on quality trades rather than quantity. I know quality is kind of a hard thing to actually describe in trading because it ends up being a hindsight situation. But you want to be in stuff that's liquid, that you have an interest in. You don't want to just like put positions on just to put them on. Pick your battles and have them be very liquid stocks and stocks that you're interested in. And of course, lastly, trading too large, you have to consider that 90% probability of success, very, very high probability. 9 out of 10 times over a lot of occurrences, you'll probably be correct. But in the short term, when you're looking at 1 trade or 2 trades or 10 trades, that's not necessarily the case. You have to be able to withstand the variance in the short term to let those probabilities play out. When you flip one coin, or if you flip a coin 5 times, you could get 5 heads in a row. That wouldn't be the craziest thing ever. If you flip it 1,000 times or 10,000 times, it's probably going to end up being 50-50.
Yeah. And trading small allows you to have a large number of occurrences because you have a variance that you can absorb, and it helps you avoid emotional trading, et cetera, et cetera. So trading small, very important. Great job.